There is roughly $6 trillion sitting in banks that are not permitted to charge interest. Not discouraged, not taxed for it. Forbidden by scripture, by law in some countries, and by a committee of religious scholars who can shut down any product in the building, which ought to make them charities. But those banks issue mortgages. They finance airports. They lend to governments. Last year, the whole system grew 21%, and the contract most of them used to do it, the one underneath the mortgage, was examined by the highest doctrinal authority in Rome in the year 1679 and condemned in writing. Rome got there first, 330 years before anyone in the Gulf opened a bank. Then, in 2009, the same contract was examined by the body that comes closest to speaking for the whole Muslim world on questions of law, and condemned again. This is not a fringe system. Islamic finance held just under $6 trillion in assets at the end of 2024 across more than 80 countries. Standard Chartered runs it. HSBC ran it in 7 countries and has pulled out of most of them. Citigroup's scholars are the same men we'll meet in 20 minutes. London has issued government paper under it, and the industry is projected to reach $9.7 trillion by 2029. And its founding rule is one you already know, because we've spent 6 films on it. Money must not have a price. Christian Europe held that rule for over 1,000 years. You've watched us take it apart. The monks, the Templars, the Medici, the Vatican's own bank. Every one of those films ended the same way. The ban stayed on the books, and somebody quietly built a door through the wall beside it. So you'd expect this system to be the exception, a tradition that kept the rule instead of renting a way around it. That is what I expected when I started reading. It isn't what I found. And the question that produced this film isn't the obvious one. Not, is Islamic banking really Islamic? That argument belongs to scholars who have spent their lives on it, and I am not one of them. The real question is stranger, and almost nobody asks it. 2 civilizations, different scripture, different language, different continent, 3 centuries apart, with no possible way of copying each other's homework. How did they build the same door? Not a similar one, the same contract, down to the mechanics. And then each one's supreme religious authority looked at that door, recognized exactly what it was, and slammed it shut. After which, in both cases, absolutely nothing happened. 2 documents run through this film, and everything else exists to make you understand them. The first is a decree issued at Rome on the 2nd of March, 1679, under Pope Innocent XI, a list of propositions the Holy Office declared false and scandalous. One of them concerns a contract with an odd, foreign-sounding name, mohatra. The second is Resolution 179, issued by the International Islamic Fiqh Academy at Sharjah in April 2009, and it concerns a contract called tawarruq. Separately, each is a footnote specialists already know, but nobody, as far as I can find, has read them next to each other. We'll do that at the end of this film, and I'll tell you when we get there. Before that, 3 things I owe you, because this subject collects bad faith arguments the way a magnet collects filings. 1. This is not a film about Muslim hypocrisy. If you've watched this channel, you already know Christian Europe invented this maneuver first and ran it for 400 years. The Catholic half isn't decoration, it's the load-bearing wall. 2. You'd expect the criticism here to come from outside. It doesn't. Every serious charge in the next half hour comes from inside the tradition, from scholars who wrote the industry's rules and sit on its boards. This is a family argument, running loudly and in public for 20 years. 3. Most Muslims in the world do not use Islamic banking. That matters more than it looks, and we'll come back to it. And here is the first thing that doesn't add up. In late 2007, the most senior living authority in Islamic finance, the man who chairs the board that writes the standards, announced that roughly 85% of the industry's flagship product did not comply with Islamic law. He wasn't a critic on the outside, he wrote the rules. To understand what $6 trillion became, You have to start with a man who was trying to serve farmers who had never been inside a bank. His name was Ahmad El-Najjar, Egyptian, an economist, and by the standards of 1963, an unusual one. He had done his doctoral work in Germany, and what fascinated him there was not the Bundesbank. It was the Sparkassen, small municipal savings banks that took tiny deposits from ordinary people and lent them back into the same town. He came home with an idea. Build that, but strip the interest out of it. In the delta town of Ghamr in 1963, he did. You would expect the first Islamic bank in history to say so on the sign. It didn't. This was Nasser's Egypt. The Muslim Brotherhood had just been crushed, and attaching a religious label to money was a career-ending decision. So the sign said Savings Bank, nothing else. The religion was in the mechanics, not on the door. And the mechanics were the real thing. No interest paid on deposits, none charged on financing. Instead, the bank took a share of what the money produced. Good harvest, the bank did well. Failed harvest, the bank ate the loss alongside the farmer. A depositor could not demand a fixed yield, because a fixed yield was the entire thing being avoided, which should have killed it inside a year. Peasant depositors, no collateral, no credit history, no reason to trust an institution. But it didn't fail. By 1967, there were 9 branches, in a region where most people had never been inside a bank and didn't trust the ones they'd heard of. Defaults were low because the bank lent to people its own staff could see from the window. Then it closed. Not for want of money. It had money. Politics closed it. 1967 was the year of the war with Israel, and the year Nasser's government finished swallowing anything it did not control. The state took Ghamr, and by 1972 folded what was left of it into the Nasser Social Bank. 6 years, start to finish. And this is where every history of Islamic finance begins. El-Najjar as founding father, the man who proved it could work. But look at what he actually built. Because something is missing from it, and that absence is the rest of this film. Ghamr had no Sharia board, no committee of scholars, no certification process, not one fatwa attached to any product. That sounds like an oversight. It wasn't. When a bank shares the profit and eats the loss, there is nothing to certify. The compliance sits in the cash flows where anyone can see it. You don't need a religious lawyer to tell you whether a partnership is a partnership. So why does the modern industry employ hundreds of them? Remember that question. Within 12 years, the scholars arrive in force, and they arrive because the thing being sold has become hard to look at. Hold that question and travel 3,000 kilometers northwest and back 284 years. Rome, 1679. A clerk of the Holy Office is copying out 65 statements the Church has just declared false and scandalous. Most concern lying, oaths, and when a man may kill another man. One concerns a way to lend money at interest without lending money. The word I gave you at the start of this film. Mohatra. That clerk has no idea he is writing down the operating manual of a banking system that will not exist for 300 years. Because what changed in those 12 years after Ghamr wasn't theology. It was that somebody handed the system an amount of money it could not possibly lend the way El-Najjar had. In October 1973, the price of oil quadrupled. Within 4 years, the Gulf states were holding a quantity of money with no precedent in their history, and for a great many of the men holding it, no permissible destination. A Western deposit account pays interest. A bond is interest with a certificate attached. An ocean of cash, and a religious prohibition against the only plumbing that existed. So they built new plumbing, fast. The Islamic Development Bank was founded in 1975. Dubai Islamic Bank opened the same year. the first private commercial one. Driving much of it was a Saudi prince, Mohammed al-Faisal al-Saud, son of the king, with the capital and the palace access to make finance ministers take a meeting, who spent the rest of the decade building institutions across Egypt, Sudan, Switzerland, and the Bahamas. On paper, this was El-Najjar's model at last, given the capital it deserved. In practice, it hit a wall he never had to face. Profit sharing does not scale. To share a farmer's profit honestly, somebody has to know what the harvest was. Multiply that by 50,000 customers across borders, and the model collapses under the sheer cost of verification. But the harder problem wasn't accounting. It was that the depositors didn't want it. A pious Gulf family had no appetite for their capital riding on a stranger's business risk. They wanted what everyone wants from a bank: safety and a predictable return. They wanted, in other words, the exact product that was forbidden. So the industry reached for a contract that had sat in classical Islamic law for 1,000 years, doing something entirely innocent. It's called murabaha, cost plus sale. Here's how it works, and I want you to watch it closely, because in about 8 minutes, you're going to see it again wearing a different costume. You want a house. It costs $300,000. A conventional bank lends you $300,000 and you pay back, say, $420 over 20 years. The extra $120 is interest. Forbidden. An Islamic bank does this instead. The bank buys the house. For a moment, sometimes a short one, the bank is the legal owner of that property. Then the bank sells the house to you for $420,000, payable in installments over 20 years. There is no loan anywhere in that transaction. There is a purchase and a resale at a declared markup, which is the most ordinary thing in commerce. Every shop on earth does it. The profit is not a charge on money. It's a merchant's margin on a real object the bank genuinely owned and genuinely risked owning. That's the argument, and it is not a stupid one. Ownership, even brief ownership, is a real legal fact with real consequences, and dismissing it out of hand is the mark of somebody who hasn't read anything. Now look at the bank statement. The payments are monthly and fixed. The total is higher than the price of the house. The difference is proportional to how long the customer takes, and the bank never saw the property, never insured it as its own, and in a great many structures owned it for a period best measured in seconds. Then there's the detail that tends to end dinner party conversations. When the bank calculates that markup, when it decides whether 420 is the right number, it does not consult scripture. It looks at the benchmark interest rate. For years that meant LIBOR. Now it's SOFR, or a local equivalent. The permitted price is calculated from the forbidden one. And this is not some awkward corner of the industry that the brochures avoid. Surveys have put murabaha and its close relatives at somewhere between 2/3 and 80% of all Islamic financing. The estimates vary. The picture doesn't. Profit sharing, the thing El-Najjar built, the thing the whole system is supposed to be about, is a rounding error beside it. And if, right now, you are thinking that this looks like a mortgage in a costume, hold that thought very carefully. Because a French mathematician had that thought about this contract in the year 1656. He put it in print, and he was merciless. 23 years later, Rome reached the same conclusion, though not before it burned his book. Paris, 1656. A series of anonymous letters begins circulating, and they are the most dangerous thing being printed in France. The author is Blaise Pascal, mathematician, physicist, the man who measured the pressure of the atmosphere. And he has decided to spend his considerable gifts making the Jesuits look ridiculous. The provincial letters demolish a discipline called casuistry, the fine art of reasoning, case by case, to the conclusion that a thing which is obviously a sin is technically not one. If you've watched our earlier films, you know the rule underneath it. Money is barren, it cannot breed, and a charge for time is a charge for something that belongs to God. Here is the part I didn't tell you. By Pascal's century, the workarounds had names, procedures, and printed manuals, and one of them is our contract. It was called mohatra, the word from the clerk's list in Rome. And the word itself is Spanish-Arabic in origin, which is going to matter more than it should. It works like this. A gentleman needs 100 crowns in cash. Nobody may lend him 100 and demand 120 back. That is usury, and in 1656 it can cost a man the sacraments. So instead, a merchant sells him a quantity of cloth on credit for 120 crowns, payable in a year. He now owns cloth. Then, immediately, in the same room by prior arrangement, the merchant buys that same cloth back for 100 crowns, cash. He leaves with 100 crowns in his hand and a debt of 120 due in 12 months. He never wanted the cloth. The cloth never left the table. In the strictest sense, nobody lent anybody anything. There were 2 sales, and sales are lawful. That is a loan at 20%, assembled entirely out of permitted parts. And Pascal never refutes it. He can't. The logic holds. Every step is lawful, and no theologian of his century can name the step that isn't. So he writes it down in plain French and lets it die of embarrassment. His target is the Jesuit casuist Antonio de Escobar, and the joke he keeps returning to is that the whole escape rests on intention, on what a man tells himself he is doing while he does it. Aim the intention correctly, and the same act stops being a sin. And mohatra was the crude version. The respectable one was the contractus trinus. Form a partnership, insure your capital, then sell your uncertain share of the future profit for a fixed sum today. 3 contracts, each unquestionably lawful standing alone, stacked, a loan at a guaranteed rate of interest. So which of the 3 was the sin? Nobody could say. That was the point. Rome's first answer to Pascal was not agreement. Alexander VII put the provincial letters on the Index of Forbidden Books in 1657, and in 1660 Louis XIV had them shredded and burned in public. So hold the sequence in your head. Rome banned the book in 1657, and 22 years later, Rome banned the thing the book was pointing at. The 2nd of March, 1679, the Holy Office, the Roman Inquisition, under Pope Innocent XI, issues a decree condemning 65 propositions drawn from the casuists. It is a house cleaning. Rome has read the manuals, and Rome is not amused. And there, on the list, is our contract. The condemned proposition reads, and this is the 17th century English translation, published in London within months because Protestant printers thought this was hilarious. The contract of mohatra is lawful, though made with the same person and with a reselling of the same thing before agreed on with a design of gain. Condemned. False, scandalous, and in practice forbidden. A decree condemning a sin is ordinary, but look at what that sentence is doing. It doesn't ban sales. It names with real precision the 3 features that turn 2 innocent sales into 1 forbidden loan. The same person, the same object, agreed in advance. Rome hadn't merely disapproved. Rome had taken the machine apart and labeled the moving parts. The same decree strikes down the softer excuse, too, that since cash in hand beats cash owed, a creditor may charge for the difference and walk away innocent. So the highest doctrinal authority in Western Christendom examined its own banker's favorite workaround, understood it completely, and outlawed it by name. Which should have ended it. It didn't end anything. But before we watch what happened next, and it is the strangest part of the Catholic story, we have to go back to the Gulf. Because the modern industry is about to hire a handful of men to answer a question that, in Rome, a pope answered himself. And unlike the pope, these men would be paid by the banks asking the question. A conference room in Manama. Somebody sets a document in front of a man in his 50s, and he reads it. It is a term sheet for a structure worth several $100 million, and the bank cannot sell it to one single customer until he signs. He signs. The bag goes back to London. That week, the same signature turns up on paper in New York, Kuala Lumpur, and Dubai. Every Islamic bank has a Sharia supervisory board, usually 3 to 5 scholars. They review products and issue the fatwa that permits one to be sold. Without that signature, the bank cannot call the thing Islamic, and if it cannot call it Islamic, nobody buys it. That is real power. A Sharia board can kill a $100 million structure in an afternoon, and it does. In Rome, one man ruled on this. He had a throne, a title, and no employer. Here, the ruling belongs to a committee, and the committee has a client. So on paper, this is a formidable check. An industry that hired its own regulator, staffed by men who answer to something higher than the quarterly numbers. In practice, there's a problem, and I'll state it the way the industry states it, because this argument has run in the open for 15 years. How many people on earth are qualified in classical Islamic jurisprudence and fluent in derivatives, securitization, and syndicated lending? Not a few hundred. The ones who matter would fit in a conference room. The man with the pen in Manama is Sheikh Nizam Yaqubi, and he is the most sought after of them. At the peak, industry surveys counted him on the Sharia boards of more than 50 institutions, 52 in one widely cited tally, including Citigroup and HSBC. 52. Consider what that means as a working week, and it is not him alone. One study found that 6 scholars, from a pool of more than 200, held close to a third of every board seat in the industry. 6 men. A third of the rulings on what $6 trillion may do. None of which, on its own, proves anything. A scarce expert is busy. That is not a scandal. But stack a second fact on the first, and it changes shape. And again, this is the industry criticizing itself through its own regulators. The bank whose product the scholar certifies is the bank that pays him. Hold that structure in your head, because you have seen it before in a setting with no religion in it at all. In 2008, the credit rating agencies were paid by the institutions whose bonds they rated. Nobody had to be corrupt for that to end badly. The incentive did the work. The rater who says no does not see the next deal. Islamic finance has its own name for the behavior: fatwa shopping. AAOIFI's own Secretary General said in public there was a potential case for conflict of interest, and for information leaking between competitors through shared scholars. Bahrain looked at limiting scholars' roles. Malaysia went furthest and made it a rule. A scholar may not sit on the Sharia board of more than one bank. You do not write that rule unless you have a problem. Now, before this turns into a hit piece, the strongest thing that can be said on the other side. It is stronger than most critics allow. One prohibition in Islamic law has no Christian equivalent, and no loophole anybody has managed to build. You may not sell a debt. That single rule kept these banks out of the market in packaged mortgage securities. When the American subprime machine came apart in 2008, Islamic banks were not holding the paper, because the paper was forbidden to them, and no scholar would sign it. Several studies found them steadier through the crash than the banks around them. So the wall does hold, in one place, which makes the rest of it stranger, not better. Because the sharpest critique here doesn't come from a regulator. It comes from Mahmoud El-Gamal, an Egyptian-American economist at Rice University, who has spent his career inside this field, and who gave the practice the name that stuck: Sharia arbitrage. His argument, compressed: the industry does not produce a different kind of finance. It produces conventional finance, wrapped in extra transactions, whose only function is to earn a certificate. And the wrapper is not free. Legal fees, brokerage, scholars' retainers, exchange charges. The customer gets an ordinary financial product at a higher price, and the difference goes as rent to the people who know how to build wrappers. And the customer pays for it. In Britain, where you can walk into a branch and price both side by side, the Islamic product comes out dearer. Every comparison I could find agrees on the direction. None of them agree on the size. Count the extra steps and you can see where the money goes. A second purchase, a second sale, 2 sets of legal fees, and a lender too small to absorb any of it. Not fraud, not conspiracy. A market in permission. That is a hard thing for an outsider to say about an entire industry. It is worse when the industry's own chief authority says it, on the record, in front of the men paying him. Muhammad Taqi Usmani, Pakistani. 2 decades a judge on his country's Shariat appellate bench, author of the standard modern texts on Islamic commercial law and, the position that matters here, chairman of the Sharia board of AAOIFI, the body in Bahrain that writes the standards the entire global industry runs on. If Islamic finance has a Supreme Court, he sat at the center of it. Many of the structures he was about to attack had been approved by scholars who learned the subject from his books. The boom was in sukuk, translated, badly, as Islamic bonds. A bond is a loan with interest, so a sukuk is not supposed to be one. The investor buys a share of a real asset, a toll road or a power plant or a fleet of aircraft, and earns a share of what it produces. If the asset does badly, the investor gets less. That risk is the whole justification. Between 2004 and 2007, the market went vertical. Sovereigns issued, multinationals issued, Western banks queued up to arrange the deals. From inside, it looked like vindication. And then, in the last weeks of 2007, the man at the top published an assessment of what was being sold. Usmani's finding? Around 85% of the sukuk in the market did not comply with Sharia. Not the fringe issuers, the market, including deals certified by boards he had trained. The reason came down to one clause. Buried in the documentation of most of these transactions was a purchase undertaking, a binding promise by the issuer to buy the assets back at the end of the term at face value, whatever they were then worth. Whether or not the toll road ever collected a toll, which means the capital was guaranteed, which means nobody was sharing risk, which means the payments were not a share of profit at all, but a fixed return on protected principal, the thing the entire structure exists to avoid. Usmani's charge was not that somebody had cheated. It was worse. The industry had rebuilt the bond with extra steps and then certified it. The asset in the middle wasn't producing the return. It was there to be pointed at. AAOIFI issued a resolution in early 2008 restricting those structures, and issuance of the affected sukuk collapsed. Though the financial crisis arrived in the same window, so anyone offering a clean split between Usmani and Lehman Brothers is guessing. The industry never disputed the diagnosis. It rewrote the standards. That is the strongest evidence we have that he was right. And it left one question standing. If the flagship product could be rebuilt into the thing it was designed to avoid, what about the ordinary business? Not the toll roads and the aircraft fleets, the overdraft, the personal loan, the cash. Murabaha solves the house, but most of banking is not houses. Most of banking is cash. A business needs working capital. A customer needs a personal loan. A bank needs overnight liquidity from another bank at 4 in the afternoon. There is no object to buy and resell. The customer wants money, which ought to be the end of the road. A system that can only finance objects cannot be a banking system. So the industry built this instead. The bank buys a commodity, traditionally copper or aluminium, sitting in a warehouse in Rotterdam or on a screen in Kuala Lumpur. It sells that commodity to you on deferred payment for more than it paid, say 120,000, due over 3 years. You now own metal and owe 120,000. Then you sell the metal, usually within seconds, usually to a broker the bank arranged, for its cash price. 100,000. You walk out with 100,000 in cash and a debt of 120,000. You never wanted the metal. The metal never moved. The contract is called tawarruq, and in its classical form, it is defensible. A man in real need sells something he owns to a stranger at arm's length at whatever price the market gives him. Nobody arranged it. Nobody took a fee for arranging it. What the industry built is called organized tawarruq, and it is not that. Malaysia constructed an entire commodity exchange, Bursa Suk al-Sila, for the express purpose of executing these round trips in seconds at scale. Palm oil, mostly. Vast tonnages that no one has any intention of receiving. If that sounds familiar, it is because you heard it 10 minutes ago in a different century. In Rome, it took a pope, a decree, and a seal. Here it takes a session, a quorum, and a vote. April 2009, Sharjah. The International Islamic Fiqh Academy, the jurisprudence body of the Organization of Islamic Cooperation, the closest thing the Muslim world has to a supreme authority on questions of law, convenes its 19th session and takes up tawarruq. Resolution 179. Organized tawarruq and its mirror image reverse tawarruq are impermissible. The reasoning: because the buying and the selling run at the same moment between the same parties, arranged beforehand, the commodity is not the subject of the transaction at all. It is, in the Academy's language, a trick to permit borrowing at interest. Riba. Now put the two documents side by side. Rome, the 2nd of March, 1679, condemning the claim that the contract was lawful. Made with the same person, with a reselling of the same thing, agreed on beforehand. Sharjah, April 2009. Impermissible, because the sale and the buyback run between the same parties, on the same commodity, arranged in advance. Same person, same object, agreed in advance. Read that last part slowly. 3 conditions. Rome listed them in 1679. Sharjah listed them in 2009. And neither list has a 4th item that the other one is missing, because there isn't one to add. Where the 2 documents finally reach for different words, they are still pointing at the same thing. Rome called it a design of gain. Sharjah called it a transaction in which the commodity is not really the subject at all. A seller who does not want the goods. A buyer who does not want the goods. 2 supreme authorities of 2 religions, 330 years apart, on different continents, in different languages, working from different scripture, and each one took the same machine apart and found the same 3 moving parts. Neither had read the other. Neither needed to. Both civilizations found this door. Both named it. Both forbade it. And then? Start with Rome, because Rome's story is finished and the whole shape of it is visible. After 1679, the ban held, and it was restated hard. In 1745, Pope Benedict XIV issued Vix Pervenit, which put the prohibition in the strongest terms available to him. Any profit demanded purely for the loan itself is usury, and no amount of clever contracting changes what it is. If you stop reading there, the Church won. But the same document opened a side door, what were called extrinsic titles, compensation for reasons lying outside the loan contract. Risk of loss, delay, opportunity foregone. And that door was never shut. It was widened, deliberately, by the same authority that drew the line. In 1780, and again in 1784, the Holy Office expanded what counted as a legitimate extrinsic title. And then, on the 18th of August, 1830, under Pope Pius VIII, Rome did something remarkable and almost entirely unremembered. It did not repeal the prohibition on usury. It could not. The doctrine had been reaffirmed too many times by too many councils. Instead, it instructed confessors that penitents who lent money at the legal rate of interest were not to be disturbed. Read that carefully, because it is a masterpiece of institutional engineering. The teaching stands. The sin still exists. The rule is no longer enforced in the one place where enforcement ever happened, the confessional. That is how a 1,000-year prohibition ends. Not with a repeal, not with an announcement, with an instruction to stop asking. Now the other side. After April 2009, organized tawarruq did not disappear. It did not even shrink. Malaysia's commodity platform kept running and kept growing. Tawarruq remains one of the most widely used structures in Islamic banking, and in several markets it underpins the majority of personal financing and interbank liquidity. So who defied the ruling? Nobody. That's the answer, and it's the uncomfortable one. The Fiqh Academy's resolution is not binding law in any country. It is an opinion of enormous authority and no jurisdiction. Every state kept its own national Sharia council, and several of those councils had already ruled the other way and simply carried on. The ban exists. The practice continues. No one broke a rule. And look where it settled. The country that wrote the strictest rule in the world about Sharia scholars, one bank each, no exceptions, is the same country that built the commodity exchange. Malaysia closed the conflict of interest and opened the warehouse. Now the promise I made you at the beginning. Most Muslims in the world do not use Islamic banking. Not because they can't, because they don't. That is the quietest verdict in this story, and nobody in the industry quotes it. The people the wrapper was built for mostly looked at it and went on using an ordinary bank. $6 trillion is not the faithful. It is institutions, sovereign funds, and the wealthy buying a certificate that the man on the street didn't think he needed. And the industry did not merely survive the ruling, it accelerated, up 21% in the single year to the end of 2024, on its way to a projected $9.7 trillion by 2029. So the two stories are the same story, almost. There is one asymmetry, and it took me a long time to see it. On the Catholic side, you can name the man who ended enforcement. There is a date, a decree, a pope. On the Islamic side, there is no such man and no such date. There didn't need to be one, because the second system never had a single authority who could have ended it. And a prohibition that nobody has the standing to lift is also a prohibition that nobody has the standing to enforce. I started this film expecting a story about religion. That isn't what it is. Two civilizations, with no contact on this question, both banned the price of money. Both worked out, independently, at their own pace, that the price of money can be rebuilt out of purchases, because a purchase is lawful, and a purchase can be repeated. Both had a supreme authority identify the trick with real precision and forbid it by name. And in both, the practice outlived the prohibition without anyone breaking a single rule. That is not a fact about faith. It's a fact about law. Ban a practice, and you do not remove it. You convert it into a contract with more steps, and the steps cost money, and the customer pays for them, and the people who know how to build the steps get rich. Your own banking system does this constantly and calls it structuring. Special purpose vehicles, off-balance sheet entities. Wrappers built so a thing can be technically not the thing it obviously is. Nobody involved believes a God is watching. The behavior is identical. Remember Pascal's cloth. Nobody wanted it. It sat on the table while two men signed papers around it, and the moment the signing was done, it went back where it came from. 400 years later, there is a warehouse of aluminium doing exactly the same job, bought and sold thousands of times a day by people who will never see it, never touch it, and never want it. That metal is the most honest object in modern finance. It exists to be pointed at. So the verdict is yours, and I mean that literally, because I've been arguing with myself about it for weeks. Is this an industry that found a way to keep faith alive inside a financial system built without it? Or is it a very expensive costume? I've told you what the documents say. I can't tell you what they mean. Comments are open, and I read them. And if you're the kind of person who needs to know how power actually works, underneath what it says about itself, that is the whole reason this channel exists. One last thing. Everything you just watched happened because nobody would say the quiet part out loud. In 1679, Rome condemned the workaround rather than the rule. In 2009, Sharjah did the same. Both chose the loophole as the enemy because the alternative was unthinkable. But there was one man in the middle of the 16th century who looked at the same prohibition and did the unthinkable. He didn't build a door. He argued that the wall should never have been there. And the argument he won is the reason your bank account has an interest rate printed on it today. That film is on your screen now.